of the biggest issues we have in the equities markets is that it's widely fragmented. We have 13 equities exchanges, we've got 50 dark pools, we've got internalization, and increasingly it's really, really difficult to really, for institutional investors to get a really good understanding of how they execute. Even though we've had TCA for many, many years, a lot of the TCA initiatives have been kind of quarterly, and it's really hard to sift through reams and reams of data, and especially with algorithms breaking things up into such small little pieces, and having the vastly fragmented market structure we have, it's really, really hard to really figure it all out. With me today, we have Jeffrey Alexander and Linda Giordano from Barclays. And they've got a new initiative at Barclays called Venue Footprint Analysis, really trying to help analyze all of this information and try to figure out, are people executing properly, and are they executing well, and are they doing the best job at directing their algorithms? Guys, Jeff, why don't you explain a little bit about what you're trying to accomplish?
What we're trying to accomplish is we're trying to take something that historically institutional investors have not been able to measure, which is what happens to their order once it leaves their shop until it gets executed. So what we've had is we've had this situation of TCA where you're sending orders out, you're getting fills back, but what happens in between you don't know.
Linda, why is this kind of so hard to do? I know we talked a little bit about the fragmented market structure.
Well, I think it's because people are trying to use traditional TCA to measure things that are now occurring at light speed. You have, traditional TCA measures where, you're evaluating brokers, you're evaluating algos in a way that it doesn't capture things like subsequent fills, and that's so important in the context of an algorithmic execution, where you're executing over and over again, and each fill has an impact, or each route has an impact. Things like that aren't necessarily captured in the proper way. So we've tried to establish some measures, some guidelines to capture that in a better way.
Well, how do you think about it? What should I be thinking about when I'm looking at this instead of traditional TCA? So when you talk about subsequent fills, I assume you mean I did 100, then I did another 100, and then I did another 100, and how does the second and third 100, the price of the second and third 100, change after I did the first 100, right?
Exactly. The ultimate concern of the institutional investors is somebody figuring out what I'm doing before I do it. So what happens is if you're going out there and you're buying, and somebody realizes you're buying, they'll buy in front of you, and then you'll get sold back. So what you're doing is you're trying to measure that. You're trying to see if somebody has figured out what you were doing and acting on it.
Now, are you finding out? You've grabbed, now you've put out a really interesting paper called Introducing Venue Footprint Analysis, and you've gathered data from 20 different players, is that right? And you've analyzed all this information?
When we started Barclays, we needed to build our infrastructure from scratch, and while we were doing that, we're walking around, we're talking to our clients, we're saying, hey, what are you guys seeing? What are you concerned about? And the answer overwhelmingly was venues. Nobody really knew how to deal with it. There were some people, they were starting to request files. Everybody was requesting a different file, giving a lot of work to the brokers as the brokers were trying to adapt to these files. And then when these guys got the files back, they didn't necessarily answer the questions that they were looking to answer. So what Linda and I did is we put together a group of these people, all these buy-side clients that we work with. They viewed this as an industry problem rather than an individual problem. So what we did was we figured out, first of all, what data they should be requesting. And once we were done putting that together, we gave them something that they could hand to their other brokers and say, hey, go out, ask them for the same information. And then we went through the educational process of, this is how you should look at the data once you get it.
So did the other brokers comply with that? Did they say, here Barclays, I'm Merrill Lynch, give me all your, here's all my data?
Well, that's starting to happen.
Yeah, I think this is, to kind of back up a little bit, it's a process where over the past, years, year and a half or so, there have been a lot of events in the news. A steady drumbeat of, different venues having issues. There are some big scandals. People are starting to think about, well, what should I be looking at? How should I be looking at it? I think you have some firms that have jumped in with 2 feet and said, just give me all the data. Perhaps not knowing the questions, just starting to collect because they feel like they need to. I think what the big problem was, we needed to define what how to answer the questions, and actually define what the questions were, how to answer them, establish a framework for doing it. In terms of, all of these buy-side firms, they're going to each one of their brokers and asking for data. if there was a standard that, we all know what the standard is, we wouldn't have to necessarily deal with hundreds of development requests. It's kind of like we know what it is this is the format. We can flip a switch and provide it to every client. So it kind of makes sense that we've had some clients that have gone to all their brokers with their with the standard we put together. It doesn't seem like there are issues complying with it. I think other brokers would welcome it because we all don't want to be in the position of getting
custom requests.
Hundreds of new custom requests.
We've had brokers actually come to us, some of our competitors, and say, thank you for taking the lead on this, because they have the same problem we do. They're getting weighed down by 10, 15, 20 different requests from clients.
Okay, so we're creating this kind of standard, open standard for TCS. That's one thing, and that's a universal good. So the question then becomes is, I grabbed all this data. What have I learned? And I think that's the interesting thing. There's some really interesting charts in this report, which is on the forum that you can download. But why don't you talk to me about some of the things that you found that were really interesting when you looked at all this data?
Oh, one of the things, just a basic question: what defines a bad route or a bad fill? I think there was a little bit of confusion. There's been some other things that have been put out that didn't necessarily, it was maybe more of a sell side perspective as than a buy side perspective. But from talking to a client, when you're going to get a call if you're a sell side broker, if you're executing an order and every fill is at a worse and worse price. So that's something that it seemed like we needed to put that out there and say that this is how we're defining a bad fill. Measuring that, measuring things like price continuance and reversion, is, what's the price trend after you've entered the market, after you're done. We put some metrics together in terms of isolating parts, where you are in the trade, or the first quartile of fills. Those will potentially be more impactful than the last quartile. Actually, the last quartile and the last fill, you'll see reversion typically after that. Understanding, what's a bad fill, how to measure it, then it kind of gives you a framework to say, well, let me compare, how this looks across different venues. The comparative analysis, theoretically, you would think it would be similar, but what we found, that there are differences. There are some venues where you see more price continuance. And then you need to start bucketing things like, well, I need to look at order types separately. I need to look at different strategies separately, the more aggressive strategies, the more passive strategies. You normally would expect price continuance, but when you see more and significantly more in certain places, then that's when you need to investigate further.
And you have the granularity of the data to really dive into the details of this?
Yeah, the data that you need to look at, sub-route level information. As Jeff had mentioned earlier, this is something that traditional TCA never really covered. You're focused on orders that were executed or residuals, things that weren't completed, but what happens to your order once it gets to the broker was something that was a little bit of a black hole.
Interesting. There are a couple of charts that, before we close up here, there are a couple of charts that I found really interesting towards the back of this, your study. One is basically looking at the impact of unfilled orders. And you'd think that an unfilled order should have the least amount of impact because you didn't get executed. But actually, you say that has like a larger impact than partially filled and completed transactions. Did I get that right?
Yes, and when we're talking about unfilled orders, just to segment it to the most granular level, we're talking about limit IOC orders where you're dealing with a period of milliseconds or microseconds. You're not dealing with orders that are out there for an extended period of time.
So I sent an IOC. You should expect to get executed or not executed, and here you got something that wasn't executed, which means it didn't find any liquidity. How could that have an impact on the market?
What we did to further segment it after we did the initial is we tried to say, okay, well, let's look out 5, 10, 15 seconds after, and let's see, given that there are no other fills, so you don't have your own market impact stepping on yourself, do we still see that trend? And even when we backed out the orders and we were looking at only the orders where there were no fills in the next time period, we still saw that there was a larger impact after the trade.
And to be fair, you're going to expect that if you didn't execute, the market's probably moving away from you. So you would expect to see price continuance. But on a relative basis, when you're comparing venue to venue, you would expect that continuance to be in the same range. And what we found with there were some venues where it was a lot higher.
The other interesting chart here is looking at round lots versus odd lots, and to a certain extent, the impact of odd lots is pretty significant, actually.
Yes, what we did with odd lots, we looked at odd lots a little differently because the math around the odd lots can get a little squirrely due to the small sizes. So we looked at a likelihood of continuance measurement. So what is the probability of an odd lot that the price continues to move away from you as opposed to the probability of a non-odd lot? And what we saw is it was roughly 25% more when you got an odd lot.
So in effect, what we're, so the odd lots don't seem like it's just me buying, 3 shares of Apple. It's somebody pinging with 1 share and 1 share and 1 share and trying to find where all this hidden liquidity is.
That's what it seems to indicate.
Yeah,
interesting.
A relatively small investment for for a lot of information.
Right. So, and I assume you're trying to help your clients better understand how to execute in this fractured framework by analyzing this information and helping them tweak or manage their algorithmic flow?
Absolutely. I mean, look, the way that everybody improves is by putting something out there that everybody agrees and everybody understands. We've tried to do something different than others in that the framework is not theoretical. It's practical. It's something that everybody understands, everybody buys into. When everybody understands and buys into a framework, it leads to change.
So last question, what do you hope to come out of this besides Barcap getting lots of great order flow?
Well, I think there's this shedding light on what's going on. When you start analyzing, just like traditional TCA, when people started looking at best execution, started measuring, things started to change. I think there's a lot of speculation about the efficacy of certain order types, what's going on at certain venues. There's been a lot, everywhere. I think that shedding a light on some of this stuff and starting to look at it, we're probably not going to get the ultimate answer right away, but we're going to get more informed questions. Things like going back to your brokers and understanding the pipes and plumbing of what's going on, having those informed questions. Well, when I'm analyzing, I see, this algo tends to be more expensive on these venues. Why? That's a better question to ask than, how does your router work?
Interesting.
And in terms of giving the buy side better questions to ask, will lead to a framework that leads to better outcome for the buy side.
About better algo development, better understanding
Better
how to manage these algos, how to set them, how to let them work within the market.
And even more attention from the exchanges and other venues.
Interesting. Well, I think we'll cut it there. Great study introducing algo footprint analysis from Barclays, and with me to talk about it, Jeff Alexander, Linda Giordano from Barclays, and thanks for joining us.